You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
It is a dangerous world out there. Volatility is on the rise and your clients' portfolios are under assault from a growing number of threats. Simple diversification is no longer enough to shield the assets under your protection. Registered investment advisors, financial planners, and asset managers need a new weapon in their war on risk. Welcome to the Advisor's Option, the program designed to arm busy advisors with the information necessary to properly manage risk in this volatile environment. From options education, trading strategies and tips, to industry news and interviews with leading advisors, you'll find it all on the Advisor's Option. The Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Swan Wealth Advisors. Since 1997, Swan has been the leader in hedged equity and option income strategies with GIPS verified results. Swan provides unique and valuable solutions to the inherent weaknesses of asset allocation, offering defined risk strategies that allow upside participation while also protecting advisors and investors against market risk. For more information about our advisor program for separately managed accounts, the Swan Defined Risk Mutual Fund, or our proprietary option overlay strategies, please contact Randy Swan at swanwealthadvisors.com. Think outside the style box. Think Swan when deciding on risk management solutions to market risk. And now, it's time to arm yourself with the latest weapons in the war on risk. It's time for the Advisor's Option.
All right, everybody. That music means it's time once again for the Advisor's Option, the program here on the old Options Insider Radio Network, where we break down these crazy products known as options, as well as these sometimes impenetrable markets known as the options markets, and explain to you how they work, how you can use them in your clients' portfolios, as well as keep you apprised on the latest developments in the world of options. After all, we know you guys are busy. You guys are out there doing what you're supposed to do, managing your clients' accounts. So we got you covered. We're here to fill in the gaps for you. My name is Mark Longo from theoptionsinsider.com, as well as, of course, from the ever-exciting, at least we hope so, Options Insider Radio Network. 15 programs, including many great archived episodes of this fine program. So if you're joining us here on the Advisor's Option for the first time, first off, welcome. Secondly, you get a lot of great archives to sink your teeth into. The easiest place to do all of that, the mothership, the flagship, theoptionsinsider.com. You'll see the scroll on the right-hand side of the homepage there. Just click on the Advisor's Option, and your journey has begun. Of course, you can always find it as well, iTunes, TuneIn, Stitcher, as well as via our mobile app. All the ways you usually find your favorite podcast programs. You can always just find the Advisor's Option there as well. And if you have a question, a comment, something you'd like us to discuss on the show, let us know. Hit us up. We do love to hear from you guys at the end of the day. And joining me on the old program today, we are fresh back from the big Options Industry Conference, so a lot to talk about there. And joining me to do just that and a lot more. Let's start off. Let's go in order of, distance. They're both kind of in the same place, so we'll lump them both together. Starting off with Chris Hausman. He is the portfolio and chief technical strategist over there at Swan Global Investments. Chris, welcome back to the Advisor's Option program.
Hey, Mark. Good to be here. Thanks for having me again.
And also joining us from the hinterlands of Puerto Rico, my old buddy from the conference just last week, Mr. Aash Vyas, the director of portfolio strategy and overlays over there at Swan Global Investments. Aash, welcome back to the network, to you as well.
Thank you, Mark.
And last but certainly not least, of course, our friends over there at OIC, Eric. He was on the network last week, so we were happy to have him there. But his team, the advisor team over there at OIC, always running hither and yon to different conferences and events, so they can't join us once again. But doing his darndest to serve in his place, sitting in on the old OIC hot seat this episode, is Matt Amberson. He is the principal of Options Research and Technology Services, a.k.a. ORETS. Matt, welcome to the Advisors Option Program.
So I'm sitting in for the great Eric Cott.
You do, so that means you have to shave your head and talk very quickly.
Will do. Let me go get my razor.
Yeah, you're in our OIC guest hot seat this week, and Matt, I know we had a little chat on the at the conference last week. I believe that's actually hitting the network sometime this week as we speak, but obviously different show, different audience. Why don't you go ahead and give our listeners a quick overview of your background in the options and derivatives markets and what the heck it is you guys do over there at ORETS.
Yeah, well, thanks. My background is I went to school for options at Kellogg in Chicago, then went to the floor, was successful down there on the floor, backed some traders, calculated some proprietary calculations to look at volatility somewhat differently, rolled out our research product, Option Research and Technology Services, orats.com, and been in business for 17 years and been backtesting for 10 years.
Well, I'm glad you brought up backtesting because it's a topic that's near and dear to our hearts. So let's get to it. A segment we don't get a chance to do often enough on this program. It's time for our Tricks of the Trade segment.
And now it's time for practical tips on how to implement options into your practice. It's time to learn the tricks of the trade.
All right, everybody, like the man said, this is the portion of the program where we break down some interesting tools, tips, techniques you guys can use in your own practice when thinking about using options. And one of the things a lot of advisors and asset managers out there really love is some hard data on the efficacy of these strategies. And that means you have to go back and actually backtest these things. And a lot of people are very familiar with backtesting stocks because that's a very straightforward practice. You know, a stock is a simple, pretty much binary instrument. Yes, no, goes up, goes down. So that makes the studying, analysis, and charting and backtesting of that and strategies on that fairly effective. But Matt, we know options are a little bit of a different beast, a little bit more unwieldy when it comes to these types of things. They have the temerity to go ahead and expire, which makes things all sorts of fun. But that said, you know, we don't hear a lot about options backtesting because it is so difficult. So maybe we'll start there, Matt, because this is what you guys do all day over there at ORATS. Why is it so difficult? Why don't we hear more about backtesting when it comes to options?
It's difficult because there's 4,000 stocks that trade in the U.S. equities markets, and they're nearing 1 million option contracts. So it's just the sheer amount of data is one. Two, so many things go into pricing an option, interest rates, and then we consider dividends, earnings dates, and many of those types of research items, and you need to know what you would have known then. So you can't just look back at, here was what happened in the dividends. You have to say, well, what did we know back then? What were we forecasting for a dividend? So it's very, very difficult. Many moving parts. It really has taken us, millions of dollars and 10 years of almost daily backtesting to get to the point where we are now.
I'm glad you mentioned kind of the knowledge source and indeed the assumptions. That seems to be the devil in the details that really upsets the apple cart, to mix all my metaphors there, for a lot of people out there who are attempt to do options backtesting. We've been doing this for a long time, about a decade here on the network, and we've been approached by a lot of people over the years who've claimed to have cracked that nut in one way, shape, or another. And whenever I look at these systems, they usually tend to fall by the wayside for a lot of the reasons you just described there, Matt. There's a lot of, for lack of a better word, a lot of assumptions you have to make when you're doing options. You have to, someone can't just, you look at a stock and can say, hey, if I bought this back in 2011 and held it to now, how would it have performed? That's a pretty simple back test to perform. But you say the same thing, hey, I want to buy a 15% out of the money call in Apple, and I wanted to do that every quarter for the last 2 years. That's a more challenging thing because right there, you already have a lot of assumptions baked into that analysis. When did you buy it? Did you buy it the instant that call was listed? How did you execute it? Did you buy it and then hold it all the way to expiration? Did you buy it and sell it 2 weeks out? Do you have some sort of methodology? The underlying moved X percent. Would you have sold that call and rolled it? So there's a lot that goes into this analysis, and a lot of assumptions. How do you deal with that? Do you talk to the client ahead of time? Maybe it's an asset manager or an advisor, and do you kind of get a feel for how they like to approach the options market, and then use that as a guidepost for your back test? How do you kind of narrow all those potential variables down?
Yeah, I mean, you mentioned a lot there. You definitely need to talk to the client, see how he's or she is executing a strategy, come up with the assumptions for fills, how far in the bid-ask spread do they need to travel? How much are they going to trade? Is it a trading desk where they could trade every day, or they can only trade a month to do a tail hedge strategy, for example? So you definitely need to tailor the back test to the realities of the implementation. And having traded and having traders, we used to compare our back testing results nightly with the realities of the actual trades that people were doing on the floor. For example, we would simulate gamma hedging, which is trading stock around an option position. And we would look at the actual trades that a trader was making versus the assumptions that we would make on the tick data that night. And that would hone our assumptions. And so I think it's vitally important to have someone that's traded or have some comparison to reality, and also listen to the customer and see how they are going to be able to implement a certain strategy.
Hey, Matt, this is Chris. One of the things I look for in a backtesting program is robustness. And I was just wondering if you could kind of describe how your backtester differs from some of the off-the-shelf cookie-cutter backtesters that, a lot of people can get out there.
Hey, Chris. Yeah, thank you. Right. Our backtesting platform can do many of like I said, the realities of how people actually trade. So we're able to put in exit strategies, because you might not hold that Apple call all the way to expiration when it's really not picking up much theta, or you can re-enter a certain strategy if it exits at a certain point. For example, if you get called away on a 15 delta call, maybe you'll sell a 30 delta call instead of selling a 15 delta call. There are realities that traders have developed that many backtesting systems can't handle. So we've tried, just over the time that we've been doing this, tried to bake in as many of those as possible. And other things is signals. Many people look at the option environment. You don't want to be perhaps buying a out of the money put for protection if the market's already down 30% over the last 3 months and the volatility is at its 100% IV rank. So we've tried to bake in as many things that real option traders really implementing a strategy can do. And then we have very fast computations, and we're in the cloud. We just did a test of 20 million back tests for a particular client. So we could do many different tests quickly and really try to look at how a client would implement the strategy and be able to simulate that in our back test.
So in all the back testing that you've done over the years and personal trading and all the interaction that you have with different clients, have you found certain option strategies that really stand the test of time, or are you finding other strategies that are kind of like cycling in and out depending upon market conditions? Is there any one strategy that sticks out for you over these years of doing all this back testing?
So, yeah, yes to both of those. One is there are definitely strategies that perform better in certain environments, and sometimes they're counterintuitive. So, for example, in this very low volatility environment, and in extremely high volatility environments, there's kind of a counterintuitive rule of thumb that we've found from backtesting that in low environments, they don't get the vol low enough, meaning the realized volatility is often way below where the implied volatility goes down to. But, since people are kind of looking at the absolute level of volatility, not the relative level of implied volatility to historical volatility, that sometimes those can be very profitable situations for selling volatility at the lows. So that's a strange occurrence that we've seen. And at the highs, it's the opposite. At very high volatility environments, they don't get the market high enough. So those we actually see long volatility strategies doing well at those high prices. Now that's hard to do as a trader, but that's what we've seen in the backtesting. Maybe that's why there are some positive ones. But getting back to your other question, what stands the test of time? We do a lot of tail hedging strategies, and we do a lot of cover call, just the basics. And what we've found is that, and you could look at the CBOS indexes, the BXM and the BXMD. The 50 volatility call selling and the 30 delta call selling. The 30 delta is better than the 50, and we're finding that more out of the money call selling is often what our clients are preferring. It doesn't get called away as much. There's more winners. You still have a decent return. So to answer your question, yeah, in different volatility environments, there are different types of strategies that perform, and over the long haul, having these out of the money calls have always been popular with our backtesting clients.
So on your point about volatility, I totally agree with you. I mean, I'm not going to belabor the point that volatility has been low this entire year, except for maybe yesterday, right? But I think, if the VIX wants to stay in the 12 handle all year long, you can still make very good income in certain strategies. And I think what's a little scarier, what you said to your point, is like when implied goes very high, it's high for a reason, and it doesn't really get high enough. And there's certain instances when you can be long vol at those levels and actually make money, whether it's scalping the vol or gamma scalping or what have you. So, I mean, that's what a lot of people don't realize. Volatility is a weird thing. Just because it's low on an absolute basis and the whole world's been crying that it's been so low doesn't mean that income strategies can't produce during those environments. What about your clientele? I know you've been doing this for a long time. You've been on the floor. You got tons of experience. You and I go way back. Can you describe your clientele and who's really using you out there and how, walk me through someone that barely knows anything about options and how you're going to help them backtest to someone who is on the institutional side, has been trading options for 20 to 25 years. How can, that wide spectrum of client get use out of backtesting in general, or more specifically your product that you offer?
Yeah, so our clients run the gamut. Today I was on a tail hedging call with someone that really didn't get options all that well, but knew, protective puts. And I think this is going to foreshadow our conversation about that interesting article, or I should say consulting report that came out. Our clients, really do mimic what the results of that report was. And I was there when they presented it. That, these, are large, we deal with some, large state pension funds. We deal with some large wealth managers, and they do have some, to the extent that they can, some sophisticated, they're much more likely to use a tail hedge strategy, for example. So our clients, like I said, run the gamut, and I think backtesting is a great educational tool. To be able to see the results of a backtest graphed over certain periods of time can be very good for your intuition. So I think it's, there's a lot to learn in options, but a good backtest of just a simple strategy can really bring it home as to, these people new to options learning what to expect, which is a huge thing. And then this is another thing that came out in that report, that people don't have the time and they don't they don't know enough about options, so that's some of the reasons that they don't actually implement options. Well, I think back testing can really help in that, because it could show them, how certain strategies perform. Option payoffs combined with actual results of backtest can really help. And so, like I said, our clientele is really mimicking that report that we'll talk about later.
I'm wondering, have you ever done a series of back tests and the performance is not good, so basically negative P&L? Have you ever recommended just doing the opposite? Is that part of the process?
Yeah, it's funny. When we're looking for strategies, some strategies just plain old will not work. I mean, it just harken back to, when the volatility is low, people want to test, that's a good time to buy. Well, it actually came out as the worst time to buy. So, that's a good example. And, even though we account for slippage, meaning, you don't get a buy and sell at the mid market. The realities are it's closer to you're buying at near the offer or somewhere near there. So you can't just use the opposite. You need to come up with a selling strategy, and the margins are different, et cetera. But yeah, it's a good point. I mean, how do you find good strategies? Sometimes you try one and it's so bad that you do the opposite.
So I've got one more, and then I'll turn this back over to Mark. Sorry for hijacking. One of the things about back testing is a lot of people complain that, well, it doesn't take into account real life issues, and you kind of touched upon that slightly. And I guess to be more specific, it doesn't measure the pain, right? I mean, back testing has specific rules that are followed, but what if you're following those rules and that position is starting to go against you, and human emotion comes into play and that pain factor starts to increase? What would you recommend to somebody out there that had spent a lot of time back testing and was going to follow those rules, but the market's just doing something a little bit different right now, or it's in between rolling or booking profits or whatever the back tester says it should do? What is your recommendation for someone who's experiencing pain following rules that they came up with through a back test?
Yeah, great question. And as a matter of fact, those people are the ones that are coming to us, because they will often say, I had a strategy that I want to use, but when the market moves in a certain way, I jump off of that strategy. And sometimes you jump off of the strategy at the exact wrong time. So what backtesting can provide is, hey, listen, this is going to be painful. And this, you kind of look at a graph and you say, look at this. You're going to have to roll with the punches when the market does this, but you'll come out of it like this. And no, certainly if the market is doing something, totally different than expected, the back test is only so good. It's just like history. History doesn't repeat itself, but it rhymes really well. You have to use the back test and understand the back test. And for example, if you're in a strategy that only happens once in a while, a way out of the money tailhead strategy, that's going to be difficult to back test because there aren't that many points. Whereas if you're in more of a high frequency back test, then there are going to be many points. So, it's a great question, but backtesting can make a systematic strategy that will actually save you from ruining a perfectly good strategy just based on your emotions, because you already know what to expect. And if you've already kind of lived through the pain in a back test, you could live through the pain a lot easier in reality.
Well, I had a bunch of questions for you, Matt, but I think Chris covered most of them. I think he missed his calling as an interviewer there. Well done there, Chris. Just one, last thing before we wrap up on the back testing topic that I know for a lot of our listeners out there who may be thinking to themselves, that's kind of interesting. Maybe I want to get my strategy back tested, or I want to do that. It sounds like, and you kind of laid it out already for us a little bit, it sounds like the strategies that are more frequent, more repeatable are some of the easier ones to back test versus, let's say, something you put on, once a year in a leap. And like you mentioned, there aren't a lot of data points really to measure Or any other good tips or rule of thumb for someone out there who's considering what type of strategy he wants to put on, or perhaps also what type of strategy, if it's worth even trying to get this thing back tested? Any sorts of things you've encountered, like I said, any rules of thumb or any advice for any asset managers out there who are considering looking into this?
Well, especially if that person is not comfortable with the strategy, thinks it has some promise, but doesn't really know how it's going to react. There are back tests that we could put together and combine certain strategies. Like it might be kind of a risky strategy, and you could also combine that with a way out of the money put, for example. So what I found that has been interesting to our clients is to test the strategies that they're looking at, but the back test will point out the risks of those strategies, but then you could always do a combined strategy. So I know it might sound somewhat complicated, but if you're selling short-term volatility, and you could always hedge that with a long-term out of the money put, for example, and it would have saved you in many different market conditions. So I think that if a back test doesn't look good on its face, it might be good combined with other ones. So not enough people are doing that type of testing, and we've actually tweaked our platform to be able to combine in certain percentages differing strategies together.
So is that something you guys will do? Someone comes to you, let's say they're writing a 3-month out covered call every quarter, and you will look at that and you'll actually maybe advise them on ways they could improve the efficacy of their strategy? Or is it more maybe on a client-by-client basis, because some clients maybe aren't receptive? They just want to have that strategy and that's it. So is that something you guys do over there?
Yeah, definitely. And we throw a lot of other statistics out, like, what's the win-loss rate? In some of these institutions, you'll have a different person doing the overlay strategy from the person that's picking the stock. And what you need to do is understand the concerns of both of those people. And for example, if I've picked a great stock, I don't want you selling a near the money call, right? But that's where our clients will have a conversation and say, listen, we want the call away percentage to be less than a certain percentage, and that'll be a lot easier for us to get approved on the strategy, for example. So it takes a lot of communication, and the back testing can really help do that.
Well, before we move on to our next segment here, Matt, if some of our listeners are interested in maybe taking advantage of your services, they have a strategy they want to backtest, or maybe they just want to pick your brains about what strategies you've seen that have worked so they can maybe adopt them, where should they go? What should they do?
Yeah, it's orats.com, and in our contact page, it goes to me and our other people that you'll be in good hands there. We'll walk you through the process of either backtesting or preparing a backtest with you. And like I said, it's an educational tool. We are talking to ERCOT and many of those types to utilize it as such. And, it's a very good way to get familiar with option strategies and dip your toe in before actually trading.
All right, we're going to keep on rolling with the show, but that URL is orats, orats.com if you want to check it out for yourself. And now we're going to keep on rolling right on into our next segment. Yes, it's time to get the buzz.
Busy financial advisors don't have time to follow the latest developments from the options market, so we do it for you. It's time to get the buzz.
All right, everybody. Like the man said, this is the portion of the show where we break down the major developments in the world of advisors and options that you guys, the busy financial advisors, may have missed because you're too busy out there managing your clients' accounts and meeting with them and talking to them rather than paying attention to the options world. And if you weren't paying attention, then you would have missed pretty much the biggest intersection of those two worlds last week. It was the annual Options Industry Conference down there in scenic and quite sunny Scottsdale, Arizona. And every year they usually have joint events with the Options Industry Conference, and simultaneous to that they have Eric and his team have their big financial advisors event. This year they kind of merged the two events. So the industry panels were interspersed with some panels and sessions about advisors and how they use options, as well as some advisors were interspersed onto the panels to kind of give their perspective. They also came out with a great study. We'll get into more detail about that in a little bit, but I was there last week, of course, and I was happy to see Aash and Matt were both down there as well. Chris was holding down the fort. Someone has to hold down the fort down there at Swan HQ in Puerto Rico. But we'll start with you, Aash, because I know you this was your first time at the event. What were your thoughts about the Options Industry Conference, and what did you see or hear, or what conversations did you have, or maybe panels that you attended that interested you and you thought would be interesting to our Advisors Options audience?
Well, I can confirm it was very sunny. This was a fun conference. It was a bit different from some of the other industry conferences, a lot more big picture and less options/vol geeky. A couple of things that I took away from it. One, there was there were two actually political sessions where you had one with a representative from Congress on the Ways and Means Committee talking about the environment going forward. And he was, he painted a fairly rosy picture. And then you had another gentleman who was more of a political consultant from another party, and he was a bit more pragmatic. And basically the net result was, this administration has a lot of things that they're trying to deliver. If they can deliver, that's great. Could be good for the economy, the markets, but they have a lot of challenges. If they don't overcome those, we might see increased volatility. So I thought that was interesting.
And Matt, you were also down there, not for the first time, I don't think. I'm sure you've been down to OIC before, but give our listeners some of your thoughts and some of your takeaways from the conference, particularly as you think they may interest the Advisors Option audience.
Yeah, so I've been to many of these, and I thought it was one of the best. I love the venue, but also the two main things. One, being able to sit in on the advisors. Many of our clients are advisors now, and I think it's a growing part of the industry, and it's great to see the combination. And the other big thing is there was an article that came out in the Wall Street Journal about traders fleeing the options trading, and we had at ORATS had helped provide the data, the background for that, and that really was the buzz for me of the conference. And the great thing is that the exchanges are listening, and they can fix this. And we see it in our backtesting, the illiquidity in some of the single stocks, and how wide the markets get. That is a problem, and I think that the industry addressed it well. They correctly state that the markets that are shown on the screen are an advertisement. How good are these markets? Show me on the screen. So I think they've come up with some good ideas, and I was able to talk with 4 out of the 5 exchange leaders and present some ideas. As a past market maker, I really think that's where the folks should be, and it applies to advisors because we need more liquid markets. We need to see where we could trade. And like I said, it affects our assumptions in the backtest and how to implement these strategies once we do come up with good backtested strategy. So those are the two main things that I really enjoyed.
Hey, Matt. One of the things a lot of people read that article about the volume and liquidity and kind of assumed it was across the board. And maybe just people didn't have time or didn't read it word for word. But I mean, volume traveling away from single stocks towards options in the ETFs and the index world has been going on for several years now. So, I mean, the good news is there is still volume and liquidity increase on the big index products and in a lot of the ETFs. So do you think that, okay, I understand that maybe on single names and some of the esoteric things, they may have some liquidity issues, but do you think the solution really is, hey, get people to start trading those again, or siphon away volume and liquidity from the big successful products such as, the indexes and the ETFs?
Oh, yeah, good. That's a very good clarification. I appreciate that. No, so not at all. what I'm suggesting is just some structural changes. What I think happens as a market maker in these illiquid products is that there's these order types now, and it's almost an arms race where they get, a sweep order comes in, and the amount of delta, which is almost an equivalent of the stock, is so much more than the underlying markets that these market makers are at risk on these, like I said, these thinly traded stocks and options that, that trade on many, many different exchanges. There are 15 exchanges now. And, listen, the SPX and VIX, if it ain't broke, don't fix it. But we have an issue, I think, on these more illiquid names. And you bring up a good point. It looks, it looks good on those more liquid issues, but I think this is reflected in, the realities of being a market maker now. It's so difficult right now to make markets. You can make markets in these liquid names, but in these other names, you have so much risk out there. Having markets open on all these different strikes and all these different exchanges that they need to come up with some way to protect the market makers, in my opinion, in order to get more liquidity going down. And that makes a more healthy market. And I think it would even help the more liquid issues as well.
So do you think, this is, I'm going way back here, do you think maybe a widening of the markets in general, just a tad, would bring back the market maker system, and that the benefit for advisors and clients in the upstairs world would be more liquidity, more strategies, more trading, more volume, and it would even itself out for everyone at the end?
People trade more when they have their expectations met, and when they don't know where a certain option is going to trade if it's 50 cents at $5. You need to, what I think the answer is to, put in some speed bumps or tiered markets, like I said, to protect the market makers. They shouldn't have to provide, 100, 500 times the liquidity that's in the underlying market. There should be some ways, and there are, and like the MIAX has some pretty interesting ways to, protect market makers, so there's not as much risk. And I even have some ideas for getting more capital in to make better markets in those underlying assets. And I think there would be more volume in there and more liquidity if the markets were better.
And Aash, I know you had some thoughts about, I know another theme at the conference was trying to get a new audience to come play in the options market, maybe for financial advisors and also just for the general options demographic in general, trying to lure some younger players to the mix. I know you sat in on some of those sessions. What were your thoughts on those, Aash?
Well, first, I'd echo what both Chris and Matt said, that it behooves us to get this stuff figured out, because it seems like the demographics of options are only increasing option appeal. There was a great panel on millennials, and there are a couple of facts I took away from it. One was that, 10 years from now, 75% of the workforce is going to be millennials. And another thing was, like, at least when I think of millennials, I think of some young person just fresh out of school. Millennials, the age range is, anywhere from 17 to 37. So, at the higher end of that spectrum, you could have somebody with a couple of kids and a mortgage who's using options in an entirely different way. And, one of the fascinating things, I guess maybe it's just a generational thing. I mean, all of us on this call are used to option chains and all that sort of thing. A lot, there's some new approaches, like, for example, trying to introduce this younger generation of options. They do things without chains. They do things without Greeks. They embed video. They use mobile devices. And it's frankly, as long as people are getting, good, solid exposure to options and risk management and the pros and cons of, each strategy, I think it's great.
Yeah, I know it's always been a goal of ours, and I think with a lot of the forward-thinking people in the network, to try to broaden that reach and that pie as much as possible. And I'm glad to see that those efforts are continuing in a variety of different ways. Speaking of the use case of options, our friend Eric and his team over there at OIC, they came out with some great data on exactly that. How do advisors use options and why, and partner with Cerulli Associates. If you want to deep dive into this, listeners, I had Eric and I believe the woman from Cerulli on last week at the conference. That session should be coming out on our network shortly. We'll try to get them on this program as well so we can do another deep dive into the study. But the findings, if you want to look for it, is called How Financial Advisors Use and Think About Exchange-Listed Options. So a very straightforward title to the study, makes it easy to find. You can, of course, head over there to optionseducation.org, click on the Advisors tab, and it will be there for you to read or to search for the title of the study as well. You can at least find an abstract online, and there are a lot of interesting takeaways. I'll just read some of the parts that really caught my eye, and we'll kind of go there. If you guys have any thoughts on this as well, I'd welcome them as well. Let's start off with some interesting and some encouraging data. I think they found that about 1/3 of financial advisors currently use options in about 20% of their clients' portfolios. If you're wondering about sample size, I believe this was about 670 or so advisors that they polled for this study. So that 1/3 number is extremely high. You know, when we first started doing this network a decade ago, first off, there was no advisors option because no one thought advisors were interested in these things. So the penetration was negligible, probably shy of 1%. So the fact that it's clawed its way up there to about 1/3 is impressive, no doubt, in a large part to Eric and his team. I hope this show has played some small part in that, as well as, of course, all the stuff you guys at Swan are doing out there with your outreach and the 10th box and all the other events that you guys are doing out there as well. Collectively, I think we're all combining to help jump that number up a little bit. And they also say these advisors expect that current usage to increase by 30% in the next 3 years, which is a very optimistic assessment. I think one of the takeaways from the options conference last week, that the outlook for options was a little dire. People were worried about volume contracting, about liquidity concentrating in a handful of issues. Of course, Chris and Matt talked about the structural issues of the market as well with the market makers and things. So there were a lot of dire predictions coming out of that conference. It wasn't a lot of optimism. So to see that the advisors of all people are very optimistic, very bullish indeed about the use case for options in the marketplace, I think is encouraging for everyone. Some other takeaways here. They say that on the study said on average, independent RIAs currently use options, use them across 28% of their client accounts. That's their broadest use across all channels, independent RIAs and hybrid RIAs. I'm not sure what their distinction is there. I'm sure that the study will explain in more detail. They expect the greatest increases in options usage rates across client accounts in the next 3 years, from 28% and 22% collectively to 39% and 33%. 35% of these advisors execute more than 20 trades annually in a typical client account. So that's pretty aggressive. That's much more than just the one covered call a month that a lot of us, I think, just attribute to a lot of advisors out there. Advisors who use these, they said they look at a lot of different strategies. The most popular, 80% of independent RIAs, this kind of surprised me, 80% of independent RIAs reported using protective puts, the highest usage rate among all channels. So that was the number one strategy, protective puts. You know, we hear a lot about income. So I think a lot of us just default to the covered call being a primary driver for a lot of these RIAs and their clients out there, but it's protection clearly is important, something that's, I'm sure, near and dear to you guys over there at Swan. Before I keep going, Aash, I know there's a lot of things that are catching your eye here in this study as well. What caught your eye before I start hitting off some more of these bullet points here from this OIC Cerulli study?
It was a great study. A couple of things that caught my eye was the number one reason, according to the study, why financial advisors stay away from options is just the time commitment. I think Matt touched on that earlier. So, maybe some of this technology we're discussing, can help mitigate that. And the second thing was, I guess it's just common sense in hindsight, but a very good question to ask financial advisors is, do you use options yourself in your personal account? And the correlation between folks who did that and then were comfortable recommending this for their clients was over 90%, if I recall correctly.
Yeah, I thought that was an interesting data point as well. That didn't occur to me to even ask that. So I'm happy that they did, because it makes sense. If you're using them yourself, you're going to advocate for them on behalf of your clients. Aash, I was a little surprised to see such huge penetration of protective puts. So that surprised you as well, or is that kind of what you expected?
Yeah, I was surprised as well. I mean, it's been income all the time, as far as the mantra that I've heard, going back as far as I can recall.
Yeah, I mean, it's always been income, and when they do want to go the protective put route, that's why I often joked, and we said it on this program many times in the past, that the collar is kind of that holy grail for the advisors out there, kind of similar to what you guys do over there with the DRS and the overlay. The people like to have protection, they want to pay for it. And so that's why the collar usually comes in. But very rarely do I see people approaching me on the asset manager side or the RIA side and say, I want to just buy a put. So that's kind of interesting in and of itself. Before we keep rolling, Chris, does that surprise you as well, that so many people are out there straight up buying puts in the RIA space, and any other things that surprised you from this study?
It didn't surprise me because buying protective puts has been one of the basic strategies since options came around. So I think it was came around before the famousness of the covered call right, if you will. So, it's one of the things that we do. We are always invested, always hedged. So we are in the game of buying protected puts. And then, as you already know, we do try to fund that with short-term income. So I know the buzz lately has been, income, but part of a sound portfolio management program is having that protected put somewhere embedded in some way, shape, or form.
They go on to say here in the study that mega team advisors, so practices with more than 500 million AUM, currently use options for more diverse purposes than smaller teams, which this is kind of confusing here. They say income generation is a primary objective for these advisors. However, they place a greater emphasis on downside risk and portfolio diversification than advisors, from smaller teams. So they want income and they also want protection. Maybe they're collar fans as well. On average, advisors who use options use them in 21% of their clients' accounts and expect that to increase to about 27% in 3 years. Some other key takeaways here from the study. Again, something I think we can all get behind. This program, they said education, the key to increased adoption of options. Advisors not currently using options show relatively low confidence levels about using them, and nearly 50% of advisors considering using options would find education related to both implementing and training on position management very useful. They also agree financial advisors in general seem to be starting to come over to the dark side, if you will. They're starting to agree on the benefit of options. The top 3 benefits options advisors cited for using options are enhancing yield and income, solving a specific client need, and creating a better investment outcome. Covered calls, long calls, and protected puts are the most common strategies, though advisors also exhibit an openness to more specialized strategies. So interesting, a lot of emphasis on the protective puts. Another thing that was interesting here, I thought very worthy, we'll have to discuss this, I think, on a future show as well, is that financial advisors really love their ETFs and options on ETFs. The most advisors frequently use options with individual securities. 19% of them who use options frequently, so the hardcore, they use ETFs as their underlying options instrument, and an additional 40% sometimes use them on ETFs. And the mega teams, so those 500 million AUM teams, use ETFs as an indirect method of implementing option strategy. So if you want a gateway drug, if you will, for the option space, sounds like options on ETFs are the way to go. A couple more takeaways here, then Matt will get your thoughts as well. Options use higher and more diverse in large practices. Like we said, 1/3 of advisors use options in client portfolios, and that use is even higher in those mega teams, the 500 million AUM, they go up to about 40%. And lastly, and this is interesting, something we've said a lot on this program in the past, some people think it's a top-down initiative from the advisor to the client to try to bring them over to the dark side of options, but actually it's the other way around, quite frequently. Client demand, client influence is a huge factor in options use. They're saying clients have a great deal of impact on what the advisor does, with about 33% of advisors saying client demand and additional client demand would certainly increase their use of options. In addition, 1/3 of advisors reported never using options with conservative clients, and 1/3 reported always using options for aggressive clients. They also have a lot of other great data here about some advisors who stopped using options, and they asked them why. As Aash mentioned, time management being a big factor. So there's a lot of great nuggets to really sink our teeth into here. I think I'll have to bring this to really folks on, and probably Eric on as well, to try to dig into this study a little bit more, because I know you guys out there really love your hard data, your hard studies, and here we got some great data for you. Matt, I know you like a little bit of data yourself. What are your takeaways and maybe some surprises and some interesting things you found from this Cerulli study?
Yeah, I mean, first of all, they did a really good job. They paid a lot of money for it, and you could go get it for free off the OCC website. And I would suggest you do that. I learned quite a bit from there. I echo your comments. I thought that was odd that 80% use puts, and then later on they said the mega teams use tail hedge strategies almost 2-to-1 over the non or the smaller firms, and I thought that was an interesting point. And I agree that these people don't have time, and if an advisor is not up to speed on something, they're not going to advise it to their clients. It seems like a perfect part of the industry that Swan's in, because if you don't have time, you could go to Swan, and you too, Mark. I mean, it takes education, and that's what you and I are out there doing with these. You with your podcast, and me with my backtest. So it seems like the three firms that are represented here on the podcast today kind of fit in perfectly with this report.
Yeah, so look forward to more data. If you want a deep dive just on the study itself, stay tuned to our network. That session will be coming out with myself, Eric, and the team from Cerulli, and we'll try to bring them onto this program as well to do another deep dive into all this data, because like I said, you guys love your data out there in the Advisors Options audience. Speaking of the audience, so we got a little time left at the end of the show here, so it's time for you guys to take the reins. It's time for us to open up our office hours.
It's time to answer your pressing questions about options. It's time to start our office hours. You can become a part of this segment by leaving a question on theoptionsinsider.com, emailing us at questions@theoptionsinsider.com, or via social media at twitter.com/options, facebook.com/theoptionsinsider, or stocktwits.com/optionsinsider.
All right, everybody, welcome to the office hours. Like the man said, this is the portion of the show where your questions take center stage. Sometimes we ask you guys a question too, like we did earlier, actually late last week, when everyone was wringing their hands about why is VIX so low, why is volatility so low. So we asked you guys, hey, looks like it's VIX limbo time, all the volatility erosion starting to make people a little nervous. So how low could VIX go in 2017? We gave you at the time the VIX was right around about 10 and a quarter. So we said, what's the low? Is it 9 is the bottom for 2017? Is it 8.5? Is it below 8? Is it 8? Or is it below 8, which would be crazy town? So we gave you guys had some thoughts. We have some data here. I can give you guys the final numbers in a moment. But first, I want to ask you guys what your thoughts on there. Maybe, Matt, we'll start with you as our guest. What do you think won our poll first? What do you think our listeners picked? And then you have a little bit of a hint in the show notes there. And then what would your choice be for how low VIX could get for the rest of 2017?
Well, like I said, there seems to be a bit of a unnatural floor, or a natural floor, to the VIX, even though the realized volatility or historical volatility might bode for a lower VIX. The VIX just doesn't seem to go down, and the only way it's going to go down is those people to feel more and more pain. So, I think the VIX is going to have a difficult time getting below that 9, 8.5, even though the statistical vol, 6 and as low as 3 for some of these periods. So that would be my pick. As far as what your listeners might say, of course, I would think that they would echo, what I said. I've been trading for many, many years, and I haven't really seen it go too much below that. So that's what I would pick.
Chris or Aash, same question for you guys. What would your personal pick be if you have one? And then what do you think is crushing it on our poll?
Yeah, so the all-time lows around 930, and like what Matt mentioned, statistical vol is the other side of the equation. And even though that can be pretty low, you're still going to have this risk premium, which averages anywhere from, about 4.5 historically. So even if you get statistical vol on a 30-day down to a 5, you're still looking at, on average, a 9.5 type VIX. So I don't think the VIX is going to see the 8 handle. I think 9 is the bottom. And especially with yesterday and having I think the VIX spike yesterday was the 7th all time. So that's going to be fresh in people's mind, and I don't think they're going to be a little bit more cognizant and staring at it when the VIX does hit the 9 handle. So I don't think it goes below 9.
Yeah, most of our listeners agree with you guys, you there, Chris, at least, about 43% saying 9 was the bottom. About 25%, though, coming in with some hardcore downside, saying about less than 8 is going to be, so look out below. And then the rest kind of falling in the 8.5 to 8 range. I think our buddy Steve Sayers over there at Barron's even chimed in. He said below 5. He said down to 5. So I think he might have been joking, but still interesting dichotomy of opinions on all things VIX. Speaking of opinions, it's a good question here from Aiden Chance about a topic we've talked about a lot here on the program. He says, hey, I heard you guys discussing the problem of lumping options funds and strategies into the alts ghetto on the last show. Yeah, that's a term I've thrown out there in the past. We'll get to that in a minute. I understand your complaints. What do you think would be a better category to gauge options performance? Well, it's an interesting question. I want to get each of your thoughts on it. Just really quickly for Aiden, I kind of coined that term. I think the question maybe is a little bit even misstated, just because I don't know if there is. That's one of the problems. People try to put all of these options and indeed all of these alternative strategies into one category. Like we see it with Morningstar now. They added an option writing category. So everything is lumped into that. If you're a protective put fund, why should you be in an option writing category? Or if you're in the alts category, why should a managed futures thing be lumped in with a covered call fund, be lumped in with a protective put fund, be lumped in with an overlay, be lumped in with whatever else that people are doing out there? Alts doesn't, just because you're using alternative products doesn't mean that all these strategies are the same. So I think that's the first part. Putting it all in this alts bucket is a complete disservice. And I think you need a lot more categories. You need income, of course. I think you need protective. You need a bunch of other maybe more nuanced ones. Maybe you go down the rabbit hole. Maybe you say, here's like a more out of the money covered call type scenario. Maybe here's at the money or in the money. Maybe you really get that granular. But just to start with, I think you need more categories: income, protection, and start breaking it down that way. Maybe volatility, and then you can start going in that direction. Maybe Matt, you're a guest, so we'll start with you again. What do you have to say here for our listener, Mr. Chance? And what do you think? What do you think we should be doing to really, start categorizing and rating and breaking down these funds in the options and indeed the alt space?
Well, I think the exchanges are doing us a favor in making these indexes, and they explain how they're doing it quite well, and they have spreadsheets on them. So I think that's a pretty good place to start. I mentioned the SIBO earlier. The BXM is the 50 delta call selling, and the BXMD is the 30 delta. I think those are helpful benchmarks, because if I understand Aiden's question, it's like, what should I expect from certain funds, and are they outperforming? And for people that combine certain strategies, you could combine those. They have a skew, they have a iron condor. That there are benchmarks out there that I personally would use to compare and judge the performance of some of these funds.
Aash and Chris, same question for you guys. What do you guys encounter this problem quite a bit over there at Swan? Your fund is probably lumped into all sorts of things, managed futures, everything else that it really has no business being lumped in with. What would you like to see your fund put in, and what other categories would you like to see for ranking and analyzing these types of funds?
Well, I think a lot of people have learned that options can be used to achieve different types of objectives. So the category that Morningstar listed was well overdue, and I'm glad they listed it. So the next iteration really is to dive inside that category and start separating the different category, the different funds and strategies that are inside there, because you have hedged equity that uses options, you have income only, you've got tail risk type funds, you have more volatility intense funds, and they're not the exact same objective. Yes, we're all using options, but they're slightly different objectives, and I think it'll take some time. And as that category grows more and more, it'll become more granular, and they'll be able to separate that into perhaps a hedged equity that also uses options, such as ourselves, or just the pure vol players only, and then start separating our product from some of the other products that take on different types of risks.
I've got time for, I think, one more quick one here. Let's go for this one from the creatively named Steve. He asks, with the VIX so low, obviously, maybe he wrote this a couple days before today. He didn't have the big spike in mind. With the VIX so low, I'm not selling a lot of options anymore because I'm afraid that I won't collect enough premium. Am I thinking of this incorrectly? Well, a lot of double negatives in there, but we'll forgive that. Chris, we'll start with you on this one. I think let's adjust Steve and his perhaps perceptions. Is he thinking of this right? VIX is low. Should he be scared to write some options?
Well, first of all, if you have a doubt in anything that you're doing when it comes to trading, the first thing you should do is either stop trading or downsize. Don't put as large positions as you normally do. So, right, it's about preservation of capital. As far as again, every time I have this discussion about the low VIX, I have to bring in the other half of the equation, which is statistical volatility. The VIX is low for a reason because the underlying isn't moving. It doesn't mean that that's not a good opportunity to make income. Again, I point back to 2005, 2006, and early 2007, where the VIX was actually lower. It hovered around 10, 12 for a long time. It never even saw 20 during that period. And those were still very good income-producing years for income-producing type strategies. So when I saw the VIX this low, it reminded me of that period, and I kept telling everyone, don't worry about it. First of all, it's cyclical. It's going to happen, but this is actually a good time to produce income because at the end of the day, whether an income trade produces or not or is successful, it's dependent upon what the underlying does once your option trade is on. So I would not be afraid of low volatility, but if you are wary of it, then don't trade as big as you usually do. Plus, as we just saw recently, at some point volatility is going to pop, and you want to be able to have enough capital sitting around to take advantage of that. So you don't want to put a huge position at these low volatility levels, but you still want to have something out there because you can still make good income during these environments.
All right, we'll have to leave it there. That music means that's all the time we have for this very fun episode of the Advisor's Option. Covered a lot of topics, covered backtesting in depth, got into a nice rundown of all things from the options industry conference. If that intrigues you listeners, stay tuned to this network. You're in the right place. We have a lot of great my interviews and conversations with a variety of different people from throughout the options world coming to the network, as well as, of course, all of the panel audio, all you guys completely for free. So, Chris, you missed it. You can tune in for free on the old network and see exactly what you missed. But before we go, let me check back in with my cohorts here on the old Advisors Options. Since you're our guest, Matt, you get pride of place. We mentioned earlier where people can go to find your backtesting software and everything else. Maybe if you want to leave our listeners a little bit of a hint, a little bit of tease of what you guys are working on, what they can expect from you guys at ORATS. Have at it, sir.
Yeah, thanks a lot. I've really enjoyed it. It was great to be on, Aash and Chris and you. ORATS.com. Especially exciting to me is some of the tail hedge backtests that we've been coming out of late. I love protecting people at the best price. You want to live to fight another day if something happens to this market. So that's what's going on in my neck of the woods.
All right, check them out over there at orats.com to learn more, ORATS.com. And Aash, we know we just got your rundown. You guys are working on a lot of cool stuff over there in the land of Swan, in addition to more upcoming Swan educational events. So what can people expect from Swan coming in the coming weeks and months?
Well, more of the same, just trying to get the message out there that it's always good to be hedged and invested. I think the last question that came out about, selling VIX in low vol environments was great. I think I echo Chris's points that maybe scale down the size. The other thing I would say is, especially in low vol environments, in addition to scaling down the size, you may want to be a bit more active because it's certainly possible to make income in low vol environments, but you're probably better off being active in your management than passive, especially when the vol is that relatively low.
Well said, sir. And that's a good point Chris made as well. We've said that on some of our other programs in the past, and it's turned out to be one of the more controversial statements we make. People really take it up in arms when they hear us saying that maybe you should consider when times when VIX is spiking and very aggressive and north of 40 and going crazy. It might be a time actually when buying it is better than selling it because it's more prone to outperform. And the same thing you guys are just saying, when it's very low and anemic right now, it tends to stay there for a while. So it might be a time when you actually may want to sell it. Whenever we put that out there, that's a very controversial point, but I think you guys have backed it up nicely on the show today. Of course, you want to learn more about what Swan team is up to, including a lot of great content over there on their Swan blog at swanglobalinvestments.com. If you want to see if they're coming to an area near you for some of their educational events, then check out 10thbox.com. That's the number 10, thbox.com. And of course, our friends over at the OIC could not make it, but check them out over there at optionseducation.org. Go to that advisors tab on the right-hand side of the page. You have to log in, so bear with them for 2 seconds there, but then you get access to not just this Cerulli study I mentioned, but all the great data they have on the use cases for collars. And if you have a question about a strategy and how well it performs, the proverbial back testing we were talking about before, well, they have you covered over there with a lot of that great data. Check them out, optionseducation.org. to learn more. And on behalf of Chris and Aash and Matt, and indeed myself, and of course Eric and his team, wherever they are, I want to thank all of you out there in the listening audience for downloading and streaming and subscribing to the show, and of course for sending in such great questions. Keep them coming, and we'll see you next time for more of The Advisor's Option.
The Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Swan Wealth Advisors. Since 1997, Swan has been the leader in hedged equity and option income strategies with GIPS verified results. Swan provides unique and valuable solutions to the inherent weaknesses of asset allocation, offering defined risk strategies that allow upside participation while also protecting advisors and investors against market risk. For more information about our advisor program for separately managed accounts, the Swan Defined Risk Mutual Fund, or our proprietary option overlay strategies, please contact Randy Swan at swanwealthadvisors.com. Think outside the style box. Think Swan when deciding on risk management solutions to market risk.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.